Welcome back to the Deep Dive. Today we've pulled a stack of sources, articles, legal analyses, industry notes, all centered on a document that I think for most of us just feels like tedious paperwork.
Right.
The individual application for life, accident, or sickness insurance.
And, it is probably the single most high-stakes document you will ever sign in the insurance world.
Yeah.
We talk about policies, premiums, payouts, but everything, and I mean everything, hinges on this one application.
It's the foundation.
It's the absolute foundation,
Yeah.
the cornerstone of the entire process, from underwriting right through to issuing the policy.
Okay, so let's unpack this. Our mission for this deep dive is to go way beyond the checkboxes and find out why total accuracy isn't just, a nice to have, but a legal necessity.
Mm-hmm.
We're going to get into the intense investigation that follows your signature, and maybe most importantly, explore how the roles of the agent and the applicant really interact.
Because the stakes here for you, the listener, are enormous. If that information is incomplete or inaccurate, it doesn't just mean a delay or a denial.
It's worse than that.
Much worse. If a policy is issued based on faulty data, a serious misrepresentation, it creates a massive legal liability. It just sets the stage for a lawsuit down the road if the insurer later has to deny a claim.
So that document is quite literally your financial safety net.
And its integrity has to be absolute.
And that first layer of quality control, that first line of defense, is the person sitting right across the table from you,
Yeah.
the insurance agent. This is where the whole relationship gets defined.
It is. The standard analysis, all the sources point to this fundamental relationship. The applicant is assumed to be a layperson.
Someone who doesn't know the jargon.
Exactly. Someone unschooled in the technicalities of insurance risk, of contracts. You are legally entitled to rely on the agent's expertise to interpret those, frankly, complicated questions and make sure the information is gathered correctly.
So the agent is far more than just a scribe, just writing down what you say.
Oh, absolutely. Their core duty is to act as your expert guide, making sure the head office underwriters get precise, unambiguous information that reflects the true risk.
And that precision, it starts right away when the application is being put together.
That's right. The agent has to ensure 4 critical details are locked down. These 4 things define the entire structure of the contract.
Okay, the first 2 seem simple on the surface, but I imagine they involve some deep conversations. Number 1 is identifying the product type and the right amount of coverage. Why is figuring out the amount so tricky?
Well, because it requires balancing what's affordable today with what you might need tomorrow. Let's say you're looking at long-term disability.
Okay.
The agent has to help you figure out how much coverage you actually need to replace your income. You might want, say, 85% replacement, but maybe the underwriting rules only allow 60% for your income bracket.
So it's a negotiation.
It is. But that final coverage amount has to be agreed upon and recorded perfectly.
And the second detail is the legal structure, correctly identifying the owner, the life insured, and the beneficiary.
Right. And we often assume in personal policies, these are all the same person.
It's usually just you, and you.
Right. But the agent must verify the correct parties are listed, especially when you start getting into policies tied to a business. That's where it gets complicated.
Then we get to the money, the premium. The quote an agent gives you isn't set in stone, is it?
No, not at all. That initial quote is just an expectation. It's based on a theoretical, standard life insured.
A perfectly healthy person.
A perfectly healthy person. If underwriting discovers a higher risk, maybe a health issue, a hazardous hobby, the actual premium may change. You might see ratings, restrictions, or exclusions added. The client has to know that quoted rate isn't a guarantee.
And the fourth detail is riders. These are the optional add-ons, right? Like guaranteed future insurability or a waiver of premium.
Yes, and I think people assume because they're optional, they don't get the same scrutiny.
But that's not true.
It's the complete opposite. Because they represent an additional layer of specific risk, say, covering a critical illness the base policy might exclude, they require their own separate financial and medical underwriting.
So you're not just tacking on a small extra.
No, you're asking the insurer to take on a whole new risk profile, and that demands its own dedicated investigation.
These details of the policy structure, the riders, the premium types, they're complex enough. But when you add in beneficiaries, the whole structure changes, especially around taxation.
Oh, this is where the agent's expertise becomes absolutely critical to the client's bottom line.
Right.
For a straightforward personal policy, like, say, Andre applying for long-term care, it's clean, he owns it, he's insured, and he's the beneficiary. Simple.
But let's get into a business scenario. This is where things get tangled.
This introduces major complexity. Let's use the case study of Hanif's incorporated business. He has two employees, Alfred and Blanche, and two very different policies.
Okay, let's start with Alfred. Hanif takes out a key person plan on him.
Right. In that case, the business is both the owner and the beneficiary. So if Alfred becomes disabled, the benefit pays out to the company.
I compensate for losing him.
Exactly. It compensates the business for the financial loss from his services. And crucially, the premiums paid by the employer and the benefits received by the employer, they have zero tax consequences for Alfred, the employee. It's a clean business transaction.
Okay, that makes sense. Now let's walk through Blanche's policy. This one is for her personal income replacement, and this is where I think people really get tripped up on the tax side.
This is the real aha moment for a lot of business owners. The structure you choose dictates whether you pay tax now or you pay tax later. There are two standard, perfectly acceptable scenarios.
Let's do option A first.
Option A, Blanche is named as the beneficiary. The business pays the premiums, but those premiums are considered a personal bonus to Blanche, so she has to report them as a taxable benefit on her income statement every single year.
So she pays tax on that amount now.
She does. But the massive upside is that when the benefits are actually paid out later, say, from an accident, that income replacement is completely non-taxable.
I see. Tax liability today, but tax freedom later. So what's option B?
Option B. The business is named as the beneficiary. The business gets the tax-free benefit, and then it pays that money to Blanche as salary compensation. The business can deduct the salary, but Blanche receives that payout as taxable income.
So tax freedom on the premiums today, but a big tax liability later when she actually needs the money. It sounds like the agent almost has to be a tax consultant just to fill out the form correctly.
They absolutely have to make sure Hanif and Blanche understand those consequences up front. Now, they aren't providing formal tax advice, but they are structuring the application to achieve a very specific intended tax consequence.
If the application form is the basic structure, the agent's report section sounds like the reinforcing steel inside it.
That's a great way to put it.
We've established the agent isn't just a recorder. They're expected to be proactive, to anticipate what underwriting will need, even if it's not a question on the main form.
That's exactly right. Every application has an open section, sometimes called agent's comments or agent's report. It's designed as a catch-all. It lets the agent report any non-standard information or even just impressions they gathered during the interview.
Is the agent basically policing the client here, trying to find something negative?
Not policing, it's about ensuring transparency for the insurer, which, ultimately helps the client get a policy that won't be contestable later on. The agent is responsible for reporting anything that materially impacts risk, whether that's positive or negative.
Okay, give us an example of a positive impact the agent should be reporting.
Let's talk about future financial changes. The application might ask for current income, and the client says they earn $75,000. But during the conversation, they mention they have a signed contract guaranteeing a raise to $100,000 in 6 months, and they want coverage based on that future income. The agent must report this, detailing the raise, the date, everything.
Because otherwise the insurer might just...
They might only issue coverage for the lower current $75,000 amount.
And I imagine the reverse must also be reported, a future financial risk.
Precisely. If that same applicant is planning to leave their stable, high-paying job in 2 months to start a risky new venture,
Where their income will drop.
and likely lead to a significantly reduced income for a couple of years, the agent must report this too. Underwriters have to know if the client's current income is about to vanish.
The observational example is the one I find most compelling. What if the client says they're a non-smoker, but when they sat down, the agent noticed their clothes smelled, well, distinctly of cigarette smoke?
The agent should report that impression. Now, the applicant might not smoke personally, but continuous exposure to heavy secondhand smoke can impact health and premiums. The critical legal principle here is that the company is deemed to be in possession of all information the agent is privy to.
Wow.
If the agent knows it, the insurer knows it. It has to be documented.
That legal principle just reinforces why this transparency is so critical, because once that application leaves the agent's hands, the insurer kicks off a deep, intense investigation to verify every single claim.
And this transitions us right into the steps underwriters take to get enough detail to properly assess the risk. They move down two main paths, verifying the medical info and verifying the lifestyle and financial info.
Let's start with the non-medical form. This is one that often trips people up because the agent needs to interpret simple answers and push for more detail.
Right. Think about the simple medical question example. The form asks, when was the last time you visited a doctor and what was the reason? The applicant answers, last July, for a routine checkup.
That sounds like a complete and honest answer to me. Why isn't that good enough for an underwriter?
Because it leaves open the possibility that the applicant is minimizing a health event. The underwriter isn't trying to catch you. They're trying to figure out if that visit was proactive maintenance or reactive, due to a symptom.
They need to know what prompted it.
They need to know. Were tests required? Was any procedure involved? Was medication prescribed? Was the doctor's conclusion totally clean? The agent has to push the applicant for that level of detail. Without it, the underwriter just delays processing and goes looking for the information themselves.
And beyond what the applicant says, the insurer might start a third-party investigation. The inspection report. This sounds like something out of a spy movie.
It can certainly feel that way. This is a private, third-party investigative agency hired by the insurer, and the agent does not order this. They seek input on the applicant's lifestyle, spending habits, drinking patterns, dangerous hobbies, high-risk recreation.
Wait, so the insurer is literally paying someone to ask my neighbor if they think I drink too much or if I spend my weekends base jumping. That feels invasive.
It definitely feels invasive, but from the insurer's perspective, they need to make sure the price they charge reflects the actual risk. If you claim you're low risk, but your spending habits show significant gambling debt, or your lifestyle involves extreme and undisclosed danger, that changes the whole calculation.
It's due diligence.
It's due diligence to protect the company from underwriting a high-risk liability at a standard risk price.
Okay. On the financial side, independent income proof is non-negotiable, especially for disability income replacement.
Absolutely. Because coverage is limited to a percentage of your pre-disability income, usually 60 to 70%, sometimes up to 85%. The insurer needs independent verification. They are not just going to take your word for it.
And that means diving into official documentation, which can vary depending on where you are.
Correct. For an individual, this means providing official income tax returns and the government assessment notices that go with them, often for multiple years to show consistency. For a business, it's even broader. They'll often demand financial statements, profit and loss, balance sheets, for at least the past 3 years.
And then there are the specific medical requirements that get triggered based on what you disclose.
Right. Medical exams or specific tests might be required automatically if you're over a certain age or the benefit amount is over a certain limit. But often it's the applicant's medical history that really triggers the deep dive.
Give us an example of how a seemingly past minor event could trigger a big investigation today.
Okay, take the case of Jorge. He applied for long-term care insurance and disclosed he had a minor heart attack 4 years ago.
Just put it on the form, thought he was being transparent.
Right. But the insurance company didn't just accept the word minor. They required an attending physician's report from his cardiologist, and they mandated a full doctor's medical exam, including a stress test.
Why so much?
They need to understand the current extent of the damage to his heart muscle and assess his prognosis before they can accurately price that risk.
And finally, those more obvious lifestyle risks. If you disclose hazardous activities, skydiving, piloting a private plane, maybe you're a commercial diver, you're going to get a special questionnaire.
You are. And that questionnaire is basically the precursor to a potential exclusion. If the activity is deemed risky enough, the policy will be issued with an exclusion rider, which explicitly denies benefits for any claim that arises from that specific hazardous activity.
So you can get the coverage, just not for the most dangerous thing you do.
Exactly.
Before we wrap up, there's one last high-stakes situation we have to address. Replacing an existing accident and sickness policy.
This is so critical because if you replace existing coverage, there is a serious danger of creating a coverage gap, especially if your health has changed since you got that original policy.
You could be dropping a policy that covers a condition the new one will now exclude.
Precisely. And the agent has a very strict mandate here. They have to follow prescribed procedures to ensure the client understands if the replacement is truly in their best interest. This means filling out a formal comparison form covering every single element premiums, covered conditions, exclusions, riders, benefit periods, even definitions.
And there's one golden rule, isn't there?
To protect the client's interests above all else, the most critical rule applies. The new policy must be issued and effective first before the existing policy is canceled. You cannot leave the client uncovered, not even for a single day, while those contracts change hands.
This whole deep dive really reveals that the insurance application isn't just about documenting your past. It's a high-stakes, legally binding process that's designed to predict your potential future risk.
It is. The underwriting process is an attempt to evaluate not just the data on the form, but your whole lifestyle, your future plans, everything from a pending salary raise to the likelihood you'll quit your job to the results of your latest medical stress test.
Which leaves us with a final thought. If an agent is legally required to disclose what they know about your future income or potential health risks to the insurer, how much of an applicant's life is truly private once you sign that initial application form? Something for you to mull over until our next deep dive.